Good afternoon and welcome. My name is Adam Rust, and I'm a senior policy advisor at the National Community Reinvestment Coalition and the moderator of today's panel entitled, "What did GameStop teach us about retail investing apps?" We're here to draw meaning from the GameStop saga, a gravity-defying frenzy that caught the attention of the world, brought a few Wall Street hedge funds to their knees, and heralded a change in how retail investors use the stock market. Notably, the event has become the grounds for which millions of Americans are deciding to enter the stock market now. And while we're not here to judge whether or not that's a good thing or a bad thing, we are here to say that it matters because it will impact many low wealth households. And if their initial foray into investing is unsuccessful, it could leave lasting harms. Market research says that increasingly people consider a fintech investing app when they decide to become an investor. And it's a popular way and hardly a fringe concept or the fad chosen by a few millennials. Indeed, Robinhood says it now has 13 million accounts, which is more than Schwab and more than 2.5 times the number held at E-Trade. So our fundamental questions for today relate to what a retail investor sees when they use a fintech app. What information do they need? Is it appropriate to use a nudge? And what is the right amount of friction in the design? And increasingly, design is very important. Some would say actually that in fintech, the design is the product. The rest of it is just a back-end kind of financial infrastructure. And we know that too much information is overwhelming, and we believe that in some ways, too little information leaves people without the adequate resources to make an informed decision. So what's the right amount? As well, it's worth saying that the current status of disclosures probably isn't working. Pages and pages of legalese and small fonts isn't really serving the purpose that the disclosures were designed to achieve in the first place. So 4 themes you'll hear today. The first is simplicity. Many people go into investing thinking with a preconceived idea that they would like complexity, but we know in fact that a straightforward approach is often more effective. Second is the idea of designing apps with nudges. A behavioral economist will tell you that a nudge should influence a user's behavior of a service in a way that's predictable without changing their options or aligning their incentives in a new way. Fintech investing apps do use nudges. And in other parts of financial services, most famously in savings, nudges have done a good job of encouraging people to make good choices. But what's the right application of the nudge in the context of investing? The third theme is the democratization of finance. Today is not like the 1970s, when only about 10% of Americans owned stocks before the rise of the popularity of the mutual fund, and when everyone had to use a broker and pay high transaction fees and had very little way in terms of access to their own independent real-time information. Today, most investing apps do use free trading, but they do that through the payment for order flow method, which in essence is a business model where the brokerage does not earn fees from consumers, but rather receives compensation from large Wall Street market makers. So in the end, free trading is actually not free, and we have to ask at what cost? And the last theme you'll hear is regulatory, and this is the case anywhere in fintech. Fintech disrupts, fintech challenges our existing regulatory systems. And so it's always important to ask, what's the right equilibrium to strike between supporting innovation and protecting investors? I encourage each of you to go to the profile bar on the screen and see the full biographical information of our panelists, but I'll provide a brief introduction here. First, Colin Wickman is the co-founder and design director at Avon, and before that, he was director of design at Square. Barbara Roper is the director of investor protections at the Consumer Federation of America, and Jacqueline Ortiz Ramsey is a political strategist and the head of communications and public policy at Robinhood. So with that, I'll kick it off to Colin.
Cool. So I want to start. I'm Colin. as you mentioned, I'm a designer and like to consider myself kind of a builder. And I kind of want to just lay out kind of the groundwork for what we are talking about today, and how myself and my teams and other designers often kind of think about building products within this space. So just to give a little context on myself, I found this the other day as I was cleaning out some old boxes, but this was something I drew maybe when I was 3 or 4 years old. And I kind of always just loved being a builder. I think I always thought maybe I'd be a construction worker, but I just love building things. And sometimes I still look out, my office window and see construction workers, and like, I envy that. I love building things. So that being said, I've spent the last 10 years building products specifically in the fintech space, starting at Square around the end of 2011, beginning of 2012. And then more recently, a co-founder and head of design at Avon, which is basically reinventing how we think about kind of the credit card and access to credit. And then, like I said, those 10 years kind of at Square really got to help build a lot of kind of the founding products, such as the card reader, all the way into kind of the lending arm, and now also the kind of peer-to-peer and investing arm in Cash App. And so there are basically two kind of concepts that I want to hit on real quick that kind of ring true throughout those 10 years for me. And the first one is really around democratization, and the term democratize. Adam mentioned that at the beginning, but I just want to put some clarity on kind of what that means and what that means to me, and especially when designing. And the goal there is really to make things accessible to everybody. It's actually one of the things we talked about early on at Square. Jack, obviously the CEO, but Jim McKelvey, who was the other co-founder, used to bring up a slide, something similar to this, recreated it, where basically at the bottom, you used to have all these companies, or sorry, small businesses, sole props, individuals, who consisted of kind of the majority of people. And then you had corporations at the top. And speaking specifically to the credit card industry and being able to accept credit cards, the people at the top were able to accept credit cards at lower rates and had kind of cheaper access to all the tools needed, whereas the people at the bottom were often either excluded or is too expensive. And so we always talked about this idea of like, can we flip this pyramid, right? Like, how can we give access and kind of democratize the payment space, right? How can you go from something like this like dumb terminal where, you had to pay monthly fees just to rent it. That's even if you qualified. You had no ideas what the fees you were paying because it changed for every card, et cetera, right? And instead Square decided like, all right, we're going to change that. We're just going to invent something new, right? We're going to invent something that, everyone has a phone in their pocket at this point. How can we allow anyone with that smartphone to accept a payment? And that's exactly what happened, right? We invented, this is a picture of the first version of our app where, plugged into, this is one of the first gen iPhones. And you can see, it now allowed someone to accept a card payment. And we did it in such a way where it was 1% for everybody, 2.75%. Like, that number will always ring kind of true for me, that 2.75%, regardless of if it was Amex, regardless if it was debit, credit, et cetera. And you can see like that's kind of something that we embraced at the company as well. This was on our wall as you kind of walk into the office. It was, make commerce easy. We want to bring access to everybody. Turning the tides a little bit, flipping to Avon, kind of the company that I'm working on now, and flipping to kind of the other side of the counter, but still talking about accessibility and kind of democratizing the finance space. Looking at the credit card space today, the average APR is around 19.3%. Average credit card debt is around $6,000, with a total of $800 billion in credit card debt, which is significant. And if you start to think about that, that's an incredible amount of money to pay on that debt. That's a very high cost of capital. And so kind of what we're looking at is, what are other ways that people could access capital, which I do believe is like fundamental to kind of investing and building wealth at a much cheaper rate. And so one of the ways we're doing that is looking at actually home equity. Home equity is a very valuable tool to leverage to actually get much more affordable equity. But today, in order to do that, it takes 4 to 6 weeks to close, 2 to 5% to actually close on that. And usually there's a 50K minimum. for a bigger bank to actually do that. And that automatically kind of rules out a lot of people, right? A 50K minimum on, if your house is in kind of the lower to mid tiers of what is in the US, think $200,000 or $300,000 home, right? You need to actually have significant amount of equity in your home, right? And so we're taking that same idea of access and democratization and making it accessible to almost anyone, and they can do that in 15 minutes, no closing costs, and a 5K minimum, right? And so it's the same idea of like bringing these tools and these concepts of accessibility and kind of creating this equality of opportunity, right? Everyone should have the ability to access tools that can help them kind of thrive, and in this case, financially. But I believe that's true across kind of all of tech, whether that's health, whether that's the environment, et cetera. Switching to kind of this second, word that kind of has resonated with me throughout my time in fintech is altruistic. And I use this because this is something that really hits home for me personally. But basically going into something unselfishly concerned for the welfare of others, right? Like, you have to believe that you are doing something because you think it is best for them. And so looking at those two words, how can you kind of take altruistic and democratize and kind of bring those together to ultimately build the best and design the best fintech product? And that's kind of what I look at. And to me, that basically means, how do you make something that's accessible to everyone and you have a positive intent, right? And kind of with those, that sweet spot, that like in the middle is where, I personally love to be, and I believe that companies and fintech companies should try to be. And so how, right? How do we actually do that? How do we create a product that does kind of embody those two sayings? And I think it really, for me, boils down to three different things: education, transparency, and simplicity. And I'll kind of walk through what each one of those really means, and then examples of what I mean within the industry. So education, provide all the resources needed to allow people to make the most informed decisions, right? Like you need to have access to understand what you're getting yourself into. I think that is a requirement. Transparency, everything should be clear, honest, and digestible. Like digestible is a key word that I want to focus on, and I'll bring up a little bit later as well. Adam kind of touched on it regarding disclosures. And then simple. The key here, right, is having access to it. As soon as you start to introduce too many barriers, you start to eliminate that access, and you start making it harder for people to actually take advantage of a tool that hopefully has positive intent, like I mentioned. And so with those three things, I kind of want to focus it now to a little closer to kind of the topic that we're going to be discussing, and that is around kind of the fintech investing GameStop world. And so here, specifically looking on the left, you have Square and Cash App, and on the right, you have Robinhood, which are kind of the two leading kind of fintech platforms for investing and crypto and things like that. And so wanted to kind of look at how each one of those are doing within that space, and kind of analyze and kind of lay out like a blueprint for how we could maybe improve the space, but also a gut check of how we're doing. Education-wise, I would say we're doing well, but still room for improvement. Something that's interesting to me is, as you increase access to a tool, I think you also need to increase education. All right, as soon as you let more people in, it's kind of a responsibility for you to actually provide more tools for someone to learn more about it. If your tool is just meant for, someone on Wall Street as a trader, you probably don't need to, talk about what a stock is and, what happens, when you invest, what is a bond, what is an option, et cetera, right? Those tools are meant for people who have maybe been in the industry, but as soon as you start to let in, let's say, everybody, I think it's your responsibility to start providing that. And so I've seen some really, really interesting things kind of happen in that space from Cash App. They did an incredible job kind of explaining what Bitcoin is, right? Did this amazing kind of pictographic tutorial on what Bitcoin is, where you can really learn and understand what it is. The same thing is true, in Robinhood, right? One of their main tabs in the top is Learn. Where it actually points you to, what is an investment? What is a stock? What is the stock market? And it's actually, like, I would say, a relatively good kind of tutorial on, what you can expect and the things that you probably need to understand before getting into it. I think it's a whole nother conversation of whether or not people actually read it and do it. But I'll save that kind of for our debate. So that's education. I think we're doing well. I think there's room for improvement. Transparency, I think is good, but not great yet. And I think the transparency is actually okay, kind of coming from the companies themselves. I think we try very hard to be transparent. But as we kind of talked about earlier, it's sometimes hard in the legal system to be as transparent as we want to be because of maybe some of the disclosures or the things, the long form text that we just can't really summarize. We end up writing disclosures for the other, opponent's lawyer as opposed to for the consumer. So looking at, for example, Cash App terms of service, you could scroll on this for days, right, before you get to the bottom. That's true for probably pretty much every website that you go to. Robinhood, same thing, right? You have a risk disclosure, which then brings up a modal, and then that gets you deeper and deeper into kind of the terms of service, the privacy policy, et cetera. And most sign-up places where you've probably seen this wall of gray text underneath that says, you're responsible for this. So I think there's a lot of room for growth there. And then the last thing is simplicity. And to be honest, I think hit it out of the park. And this is actually going to kind of transition me into my last thought before passing it on to the other members here. But that's one of the biggest things that kind of tech and specifically fintech has done so well, right? It took it from someone on the trading floor where you had no access to actually being a part of kind of the stock market, right? To then, maybe there were some tools, you had E-Trade, you had Fidelity, there were some earlier tools, but it was still a bit of a barrier to get in there. To all of a sudden now there was like a zero commission, right? You can download it on your phone and you could start to participate in something that I feel has built some of the biggest wealth in the world. And so, it went from that to something on your phone, right? It kind of hit it out of the park in terms of simplicity. And kind of the last thing I want to just touch on is, did it get too simple? Did it almost get to a point of where we're talking about gamification now? And I think this kind of brings into an interesting point where, for example, this is Robinhood, which, offers a free stock when you sign up, right? It's very enticing. You have a 1 in 70 chance of getting an Apple, Visa, or Johnson & Johnson stock, et cetera. Or even some of the, we're talking about GameStop today, some of the meme stocks, the things that are attracting people to this, is it making it too easy? And is there some level of responsibility that we have in order to basically have people participate in this in a way that is beneficial to them as much as we can? And I know I didn't want to get to this, but it ends up being kind of a gray area. And I mean this in the sense, I can take kind of both sides, but I do fundamentally feel that if you feel like you are providing a tool that kind of empowers someone to do something that they didn't have access to before and is fundamentally better if they have it than if they don't, and you provide the education, I definitely think that access is where we want to be. And so I think we're trending in the right direction. There's always room to grow. There's always places that we can, improve things, whether that's disclosures, whether that's, things we're doing in design, whether that's the education itself, how do we make it more hands-on, more interactive, et cetera. But I think we're going in the right direction. I do think this is a positive trend where people have access. And I do think, we really benefit from people having this. And progress is a nice word, but change is the motivator, and change has its enemies. So I think we just kind of have to embrace that change, and how can we work together to actually make that happen? And so with that, I want to pass it over to the other panelists.
Thanks, Colin. I think that was great. I think you really did a great job of showing how there's so many tensions that are interacting with each other directly. Access to a product, education needed to use that product, the design of the terms and the design of the use. So I think that was a great overlay. And so Barb, please kick it off with your thoughts next.
So I guess I'm to the skeptic on today's panel, which will come as no surprise to those of you who know me. But let's start with sort of the good news, which is that technology has been transforming the delivery of investment services for the better part of 4 decades. So if you look back to the beginning of, to say the late 1980s or the early 1990s, online brokers allowed investors to make trades directly at much lower cost without going through a traditional Wall Street firm. No-load mutual funds began selling their products directly over the internet, and their websites included tools that investors could use to develop an appropriate asset allocation plan or estimate how much they needed to invest to reach a retirement or other goal. More recently, the so-called Robo Advisors have made it possible for investors with just a few $100s to invest toward long-term goals in a diversified portfolio of ETFs at rock bottom prices, and including automated features like portfolio rebalancing and tax loss harvesting. And meanwhile, behind the scenes, technology has been transforming everything from the way firms onboard customers to the way they actually manage their portfolios, so that it makes it possible for traditional firms to serve a broader segment of the investing public at an affordable cost. So each of those developments has, in a very real sense, helped to democratize access to investing, democratize access to the markets. So when trading apps like Robinhood come along and claim to be democratizing access to the markets, they're not wrong, but they're also not the first to do so, and nor would I argue are they the best in terms of the real benefits that they're delivering to investors. So the real innovation here lies, in my view, not so much in providing inexpensive access to the markets, which already was widely available if you knew where to look, but in making the investing process much more appealing and engaging, particularly for a generation raised on video games. And it is certainly true that Robinhood has attracted a much younger, more diverse population of investors to its platform, many of them first-time investors with modest amounts to invest. They are reaching an audience that Wall Street firms have struggled to reach or not cared to serve. But the question I keep coming back to is this: is what we are giving these inexperienced new investors access to actually beneficial for them? And in one sense, again, the answer is clearly yes. It is absolutely possible for investors to use the app to do the kind of boring investing that I and many others believe is most likely to result in long-term success. Buy and hold investing, broadly diversified portfolio of low-cost ETFs or mutual funds, and many of Robinhood's customers apparently do just that. But for Robinhood to be profitable with its business model based on payment for order flow, it needs a certain significant percentage of its users to engage in frequent trading, better yet trading in options or on margin, that is frankly highly unlikely to result in long-term success for those investors. And the app makes it extremely easy to do just that. And so I think it helps to think of it this way. If Robinhood were a traditional broker, it could never recommend that its typical inexperienced small account investors engage in this kind of frequent trading or trade options or trade on margin. That would run afoul of basic sales practice rules under the securities laws. And when this issue is raised, Robinhood has argued that it doesn't make recommendations, so those rules don't apply. But does its app encourage those practices? And a number of people have concluded that it does. The most noteworthy being the folks in the Massachusetts Securities Division, and they've brought an enforcement action against Robinhood, which includes this as one of its claims. But they're not alone. Long article in Bloomberg Wealth yesterday asked if Robinhood has made it trading too easy, too hard to resist. Another article by a gamification expert put it this way: Robinhood makes Wall Street feel like a game to win, not a place where you can lose your savings. The investing app, according to this author, relies on gamification techniques that can encourage people to discount the real-world costs of their decisions. He suggests that Robinhood uses gamification to obscure the complexity of investing in stocks and other financial instruments behind a fun, game-like environment. Gambling addiction experts have raised similar concerns, arguing that Robinhood's design induces dopamine rushes, much like gambling apps do, and that its one-click trading allows for instant gamification. So the process starts with the offer to new users of a free stock. The user selects one of 3 face-down golden cards. It then scratches it like a lottery ticket to learn which stock they won. Other gamification features experts point to as potentially problematic include the use of imagery like gift boxes and emojis, push notifications, and wait lists, where users can improve their position by tapping up to 1,000 times per day. The combined effect, according to one academic who studies gamification, is that Robinhood creates players rather than investors. And that, in my opinion, is not necessarily good either for those investors or for our markets. And that brings us to GameStop. The more our markets are made to seem like an online multiplayer video game, the more likely we are to get events like the GameStop trading mania, where stock prices become completely unmoored from anything that rationally relates to their fundamental value. And the more that occurs, the less efficiently our markets function as a way to allocate capital to its best uses. Just to be clear, I am not blaming Robinhood for the GameStop mania. Lots of other forces were at work there. But the ability for investors to engage in seemingly cost-free stock and options trading with inadequate warnings regarding the potential risks through an app that makes it feel like a game did, in my opinion, play at least a contributing role. So what's the answer? I think there's both a design answer and a regulatory answer. So on the design side, Robinhood and others could use these same gamification features to promote practices that are beneficial to investors. They could, for example, develop a gamified test designed to ensure that investors really understand the risks of options trading, that investors would have to work their way through before being able to engage in options trading. And if sufficiently rigorous, that could help both to educate investors and to introduce friction into the system in a way that I think would frankly be highly beneficial. Or they could develop a gamified approach to other investor education topics and offer rewards for completing those modules. For example, when a user engages in particularly rapid trading in and out of stocks, the app could send the user a notification that says something like, hey, we see you've been doing a lot of trading lately. If you aren't careful, that can have costly tax implications. You might want to check out this video on the tax rules around wash sales. And they could offer some in-app reward for watching the video. At least investors would be on notice about the risks they're taking. Instead, when that information is available, you may have to go looking for it, and it may not be all that easy to find. So yesterday, I've looked around on the website. Yesterday, I decided to download the app on my phone in preparation for this panel. And it is easy to access, although my bank was strangely averse to connecting to the app. So I only got so far. But in going through that process, just by answering a question that I know what I'm doing, the next question I got asked was whether I wanted to enable commission-free options trading in my account. The app didn't, at least at that point, do anything to verify that I actually do know what I'm doing. And I can assure you that when it comes to options trading, I don't. And when I clicked on a button to learn more, nothing I saw there warned me of the risks. That information exists on the website, but it wasn't there when I was making a relevant decision. In other words, Robinhood could, of its own volition, decide to put its considerable design skills to work to promote the kind of eat your vegetables investing that is most likely to result in investor benefits, but that would be both more boring for its users and potentially considerably less profitable for Robinhood. So what's the solution? And I think there are both, I think if Robinhood chooses not to go down that route, Robinhood and the other apps that are also active in this space, there is a regulatory solution that I think will come. On the one hand, the SEC could act to severely restrict or even ban payment for order flow, get much stricter in its enforcement of the best execution rules. And while by no means certain, I think this is not entirely out of the realm of possibility under the new leadership at SEC. And that would force Robinhood to develop a very different business model that could affect all of these other, sort of downstream effects of the payment for order flow business model. Or alternatively, or in addition to that, regulators could look at imposing regulation on gamification itself. In other words, so even if you accept Robinhood's argument that the nudges it builds into its system don't rise to the level of recommendations, as we have traditionally understood that term, they are something. And there should be some accountability around those design choices. And the goal, in my view, should be to hold firms accountable for designing their apps and their platforms with the best interests of their customers in mind, so that they can't do indirectly through nudges what they would be prohibited from doing directly through a recommendation. And while I'm not sure what the outcome will be or exactly what that would look like, that is an area where I feel fairly confident we will see additional regulatory scrutiny in the coming months. So I'll leave off there.
Thanks, Barb. I think that was great. It's an interesting point to hear how this has been something that didn't start 5 years ago. It started a long time ago. And the democratization of finance is an ongoing thing. And I think what you've really raised is a question of fit, which really gets back to the tension that Colin talked about. How complicated should it be? If you're having access, does more access lead to a need to a different product that has more education? So really rich. And now I'm really excited to have Jacqueline here. And she's batting cleanup. So take it away, Jacqueline.
Thanks, Adam. And kudos to Colin and Barb for your presentations. I think you both raised several aspects that I think we can all agree on, which is this need for education around financial education in America, the need for more access. I like how Colin bulleted out education, transparency, and simplicity, which I am totally on board with. Before I get into Robinhood's mission, before I get into talking through maybe a little bit about design and the customer trends that we're seeing and what we're responding to, I did want to just top of mind kind of come up right behind Barb and just clarify two things that she said that were a little bit inaccurate. One thing when it comes to understanding day traders, and we can, I'm sure that we'll get into this with Q&A, but when it comes to pattern day traders, that's only 2% at Robinhood or less. And we actually do restrict those accounts subject to meeting certain requirements, including account significant equity. A majority of our customers outside of that 2%. So most of our customers are actually buy and hold. And often using small dollar amounts and fractional shares of publicly traded stocks and ETFs. I think the median account size is about $240. So I just want to kind of correct that. We actually do not see pattern day traders, actually less than 2%. The other item here is when we talk about notifications, Robinhood's design is built to encourage people to be aware of, let's say, if once you move money from your bank account and it transfers to your Robinhood account, you get a notification in the app letting you know your money has settled. But there are actually no, we don't guide people to trade a certain stock. We actually don't have any options or notifications on that front. So anyway, just wanted to kind of paint that up here at the top. Very excited, Barb, that you downloaded the app. We'll have to talk more about it. I'm sure your insight will be useful. So again, I'm happy to be here with you guys to have this discussion. It's incredibly important for us to be talking about this right now. I hope that this is the beginning of more discussions to come when it comes to investing in America. There's really been never been a better time. As you guys know, at Robinhood, we say our mission is to democratize finance for all. There's a reason for that. There's a history to that. What does that mean? Because we believe that we are all investors. And I will say personally, as a brown Latina who was born and raised in South Florida, from a very, Puerto Rican American family, the concept of investing in wealth generation was not necessarily the same kind of concept as it was in the white families that I grew up with. Also keep in mind, there are historical conversations around financial wealth in America that simply do not reach our communities. And I do want to point that with this mission of democratizing finance for all, that's exactly what Robinhood is talking about, is making sure that we can get more people up to speed with understanding about their options when it comes to building wealth or financial freedom. Per Fed data, I think they released data at the end of last year that over the last 7 years, stock owners are younger and more diverse. Barb referenced that as well in her panel. She's absolutely right. I do believe that Robinhood and what we're called as the Robinhood generation is at the heart of this shift. Within our own customers, we're seeing that 37% of our customers are non-white. I want to stop there and point out 37% of our customers are non-white. That's a big deal compared to our peers who have 20% that are just 20% are non-white. That 17% gap, I think, is not a fluke. I think that speaks to how the app has been incredibly welcoming in our messaging and in our approach and accessibility and simplicity, as Colin put it. Right now, we're approaching nearly 17% of our customers are Hispanic, 10% are Asian, and 9% identify as Black or African American. These numbers track with the average US population. So we are over-indexing in some cases with some of the minority communities. And we hope that that continues. Nearly 50% of our customers are first-time investors, yes. But as I said, a lot of them, a majority of them are buy and hold, and they're accessing our Learn articles at an incredible rate, which I'll get into in a minute. And the median age of our customer is 31. So we're not talking about 20-year-olds or 19-year-olds. We're actually talking about, folks who are a little bit more like me, mid-career, who are, potentially have school debt, who are just looking to get into the U.S. stock market. And that brings me back down to this tangent of our mission of democratizing finance for all. Robinhood's platform is also breaking down barriers, not just with this notion of breaking down barriers for a new type of investor or this new generation of investors, but it was breaking down barriers with how the industry operated to begin with. I know Barb mentioned payment for order flow, which has come up quite a bit since GameStop. I want to be clear that PFOF existed for decades, and keep in mind that traditional brokerages use PFOF and still had commissions on trading stocks, whether it's $5 or $10. So this part of it being a revenue model has been in the industry for a while. But when Robinhood came in, we saw an opportunity and said, we don't need to charge people for every trade. We can get rid of that. And there are 5 ways actually with Robinhood's revenue model, there are 5 ways that Robinhood makes money. So we pioneered commission-free trading. The industry followed suit. That's a good thing, right? We have fractional shares. The other thing that's getting overlooked is this option that Robinhood came up with, this idea where if you only have $5 or $10 or $1 to buy into a stock, you can do that. This is allowing people who don't have a lot of money to finally start investing for the first time. Again, we're talking about some shares are at $3,000 or $2,000. Most people don't have that to just invest. And customers know, and in our disclosures, we do talk quite frequently about and everywhere that investing is inherently risky. And as Colin mentioned, we have our Robinhood Learn, which is an incredible educational resource hub that we have that talks about the stock trading 101, ins and outs of stock trading, diversification of portfolios, crypto, what that means, and also this understanding of why it's important to look into these things before you start trading. And then, you know, outside of the pioneering of commission-free trading and disrupting the industry from a product standpoint, you know, we're also trying to push through breaking down this barrier of, or challenging the original identity of who an investor was, or when we think of who an investor is, let's be honest, it's typically a white man who doesn't look like me. It's typically a white person who has a lot more money or comes from a family that already has those links or the educational resources, or maybe a grandfather or somebody who has been down this road before. And so we want to disrupt the market as well when it comes to this idea of getting more people to see themselves as being able to be an investor as well. Being new, in my opinion, does not equate to being not smart, or does not equate to somebody who is not capable or willing to do their homework on their own and figure out the ins and outs. And again, that's why it's incredibly important that educational tools, which we are tripling down on even more so this year, are incredibly important for us to push. You know, the US stock market is one of the greatest wealth generators in American history. You know, that's one of the reasons why Robinhood was created, was in recognition of this massive wealth gap. We cannot overlook that in this conversation. While I do think that there's more to come in terms of this industry and what the future of it will look like, I think we have to stop and make sure that we understand that Robinhood and emerging technologies like it and emerging platforms like it are providing an opportunity for people to learn about investing. Salaries alone are not enough for people to build wealth these days. It's just not. And so we believe investing shouldn't be reserved just for the 1%. You know, in 1990, at the median age of 35, baby boomers held more than 20% of the nation's wealth. Today, for that same age group, millennials hold just 3%, right? So we're facing a generation of young professionals that are indebted, more indebted than we've seen in generations. And they're hungry. They're hungry to build wealth. They're hungry to find an opportunity outside of their job, outside of their salary, maybe to build savings, maybe to build towards a bigger future. So that in itself, that passion, that genesis, that idea, that hunger really lies at the heart of what we do and why we do it at Robinhood. And so when we break down, you know, again, going back to this, you know, breaking down things by generation and race and ethnicity, the gap is only getting bigger. We saw how COVID impacted Black and Hispanic communities. Washington Post wrote an article last summer that the gap between the finances of Black and white Americans was still as wide as it was in 1968. It's 2021. Why are we here? And so, you know, with white families vastly outperforming African Americans and Hispanics in several key indicators, those several key indicators are in the investment and equity space specifically. You know, obviously we know the reasons for that, and that's not what this panel is for, but I bring this up because knowing is not enough, but action has to take place. We have to take action. We have to use, and we have the opportunity to use technology and fintech to move us forward. And as Colin said, change invites challenge, right? And so Robinhood is up for the challenge, however, and does believe in continuous improvement and having these discussions and having a seat at the table with policymakers, with industry, with business, but also making sure that we keep the people who are actually impacted by policies and our business and bringing them to the table, that we keep them and their voice and their opinions as part of this discussion. So that's going to take me into, you know, the focus on our customers. And from day one, we've listened to our customers when building the stock trading app. The founders, Beju and Vlad, were very keen on that. And still till this day, we take customer feedback and input constantly. You know, Robinhood was created to simplify investing and in the process, make it more intuitive and accessible. And as simply put, our platform is modern. We meet the customers where they are. We are meeting them with the tools and in a way and in a language that this generation wants and understands. So building a platform isn't done in a vacuum without guidelines. I want to be clear as well and give a reminder that Robinhood Securities and Robinhood Financial are regulated by FINRA and the SEC. So we want to, of course, be a responsible platform, and we have to be, right? We have to play by the rules, hence why we had to make some decisions that we did on January 28th. And so when we survey our customers, we learned that most of our customers surveyed actually said that Robinhood helps motivate them to save money. It motivates them to learn about investing. So I agree with Barb in that there's the opportunity, right, to leverage your educational resources to continue to make sure that people that use your platform have the access to the tools and the resources they need to understand it. Absolutely. And that is what we are doing. And we believe in long-term investors. We believe in being especially inclusive, versus the old model that was frankly exclusive. Whether or not something existed a couple of decades ago, I think to me doesn't say anything, because we are here now. And I think we have to move forward now with the technology that we have. And I think with the technology we have today, which is a platform that's used by Robinhood, that Robinhood uses, I think we have the opportunity to move forward and get even better and find those solutions for consumers to help them on their journey towards financial freedom and building wealth. So I think overall, Robinhood gets it. Customers are in control over where and when and how they invest and with how much money. We are a self-directed platform. So the customer can use small dollar amounts, again, fractional shares, or choose what they can get into. And to that point, not every customer actually can do margin trading or options. I know I'm a Robinhood customer. I was a Robinhood customer before I was employed there. And in my account, I can't trade options. So that's actually not accurate to say that everybody has that opportunity, because they just don't. So again, we take pains to make sure that we're not necessarily like throwing people down this lane of blindly trading and forcing them. That's not the case at all.
Hey, Adam, can I have a chance to just respond to a couple of points?
Sure. We're about to have to close.
So I would just point out that if you're a buy and hold investor, a $5 trading commission, which was commonly available, or the 25 basis points at a Robo Advisor wasn't an impediment to investing. And free is not automatically good. People do things and take risks when something is free that they wouldn't take if there was a little bit of friction built into the system, if they were forced to just pause for a moment. So all of the things that the design of Robinhood enables do sort of take, I just don't think free access to options trading, frictionless options trading, is an unadulterated good for the investors, or will lead to the prosperity that Robinhood says it wants to create. Investing in individual stocks is generally a losing game, even if you're doing it through fractional shares. And while only 2% maybe of the customers may be engaging in pattern day trading, the level of trading is higher than it would be if there was more friction in the system. And something, according to Congressional testimony, like 12% of the customers engage in options trading, which is high considering who the typical customers were. And look, according to data that's online about what the revenue sources are, 2/3, in the neighborhood of 2/3 of Robinhood's payment for order flow revenue comes from options trading. So the business model has conflicts of interest in it that aren't obvious to the investor. This is like, and I have criticisms for the traditional models that are just as extensive as passionate, but I don't think we should skate over the effects that of the design decisions that are made that are not altogether healthy for these new investors.
So let me let Jacqueline respond, and then we probably have to wrap it up. I'm glad we got all of you people here, because there's so much rich information that you have to offer.
Yeah.
And we don't have enough time for it. So Jacqueline, last thing, and then we'll close.
Sure. I think it's important to benchmark. And I'm glad, Barb, that you said that, you have criticisms for traditional brokerages as well. Look, I get it. Robinhood is in the limelight. rightfully so. We became synonymous with retail investors. Again, I would say though, the conversation around education and simplicity should happen. And I think that a recommendation to make it too difficult to invest, I'd be curious to know what your vision of that would be, simply because there are ways in which Robinhood, for instance, does include, and I know we couldn't touch disclosures too much, but it's not like you open the app and there is nothing provided. There are guidelines provided and disclosures provided, and we take that seriously, and we have to. But I would say, outside of discussing the revenue model or anything else, an overcorrection or a recommendation to completely rid of PFOF, and there are studies that talk about if we rid of PFOF, what that would look like, you actually end up swinging to the other side potentially, which would make trading more difficult or more expensive. So I think that it's a good thing to look at. I think that there are trade-offs, but to be clear, what Robinhood is doing right now and the response that we're getting from the public shouldn't be overlooked. And when I say shouldn't be overlooked, what I mean is there's clearly something that we're touching on, and we're talking to consumers of different ages. Again, the median age is 31, yes, but we also have more experienced traders as well coming in who find the app delightful and find the app very powerful. And I think that friction is good. Friction leads to progress. So if we talk about all the friction maybe that Robinhood is getting right now for how popular its platform is, I think that's only going to lead us to a point of being able to find even better solutions, whether it's in design or educational tools or the like. So I guess that's all I've got, Adam.
You want to give Colin a chance to say?
Yeah, one last thing here, just to wrap this up. It was interesting for me. My wife, she's from Ecuador, and did not grow up with any sort of kind of knowledge about the stock market. That was just not something that her family was involved in. And it was interesting, to see her, she uses Cash App, very similar to Robinhood, and to actually see her engage, right? Like, it was something that she had no idea about. She was not going to sign up for an E-Trade account. She never heard of E-Trade. She was not going to sign up for Fidelity, but she found Robinhood. She's heard of Robinhood. She's heard of Cash App, and started to engage. There are going to be good outcomes, and there are going to be some outcomes that are not ideal, and that's true for kind of any investor. But for me, it's just such a positive to see people start to engage, because if they don't, these companies will go away, right? Robinhood will go under, Cash App will go under, it'll close, and those windows will now no longer be open. And so, if people are not engaging, I think, those tools are going to disappear. And I feel like those tools are valuable. So I think we just need to find a way to make it a safe place, but still a valuable place. It needs to be here.
Great. Well, I want to thank our panelists. This has really been a great conversation, and we have a great set of voices here. I hope we can have a Q&A, possibly. Thanks for listening, everyone. This is a really important topic. It's how we get to a just economy to build wealth. This is it. So thank you, and have a great afternoon. So that was a good panel, and I feel pretty good about all the things we went over. I thought maybe since we do have some questions in the queue, that maybe we could address those. You can see 3. I believe we talked a little bit about disclosures earlier, and there's a question here about disclosures and gamification, and whether or not there is actually a way for, I think kind of the question is there actually a way that a disclosure can address gamification? Is that something that can be a compatible can be resolved in a compatible fashion between the design of the app itself and then those kinds of warnings. So any of you want to jump in on that one?
Sure, I'm happy to jump in on that. I think the issue here is, can we take gamification, which can equally be a force for good or, for less good, and apply it to disclosure, which is an area where our securities laws are, I think, a complete and utter failure. The traditional disclosure approach doesn't work. For example, in a traditional business model, if you want to engage in options trading, you can read a 190-page disclosure document of dense legalese. And if you can get through that, and if you understand a word of it, so if you have, a securities law degree from one of the top universities, great, you're good to go. And no one should pretend that that's doing investors any good. So the question is, could you take this tool of gamification, making information more engaging, making it easier and more appealing for investors to engage, and apply it to some of these things like disclosure? Could you, and believe me, the regulators would have to get out of the way, right? Because they're the ones who've created these rules that have made disclosure so unappealing and ineffective. But could you take gamification and then come up with a way to illustrate in a sort of real world sense what the risks of options trading look like, that someone would have to go through before they can engage in it, or do that for the risks of margin, or do that for any number of other things we want investors to understand? And I think that is actually a promising area going forward at a moment when I think the Securities and Exchange Commission is actually ready to start thinking about whether there are new ways to approach the delivery of information to investors that take advantage of what technology makes possible.
Totally, and I think you also are. I mean, you're starting to see that in education as well, right? Beyond just fintech, but just actually using gamification and different kind of educational tools to teach people things, right? A textbook is not the only way to learn something. And we're starting to see that with alternate ways for education. And I think you're going to start to see that, in this space as well. Like you said, it's not the 190-page disclosure that's going to actually teach someone something. It needs to be something different.
The only thing that I'll add here too, Adam, is when we talk about this term gamification, the SEC Chairman Gary Gensler brought this up in the recent hearing on GameStop on the Hill last Thursday, I believe. And he finally put what we said was meat to the bones of this description of what gamification is and is not. And it was incredibly useful because I think we need to disentangle the discussion about good design and simplicity, as Colin mentioned in his great presentation, and how that can be used as a force of good to help drive people to better understand what they are investing in and how they are investing, versus gamification. And the reality is that per these definitions of what gamification is, I do want to be clear here that actually Robinhood's platform, and I would argue a lot of emerging technologies, don't do gamification by Gary Gensler's definition, which is bonuses, competitions and leaderboards, points, rewards, and this idea of the nudges. We don't do any of those things. What we do is make sure that we allow customers to opt in to receiving notifications, for instance, about if you place an order, right? You're going to get a notification saying, hey, the same way that if you order shoes on Amazon, you get an email or a text that says, hey, your order has been placed. So I think we have to be careful with, and again, disentangle design, good design that helps people versus gamification. You can't play a game if there's no game to be played.
So I'd just like to point out that there are academics who spend their careers studying gamification who believe that Robinhood's design includes elements of gamification. I'm not personally a gamification expert, but I do think there would be a pretty strong pushback from someone who was.
That's fine. It's a belief, but it's not really proven.
Right. And so before we get kind of loggerheads on that one, because I think we could. There's another question about data. And just in terms of, collection of data, we've heard a lot about the democratization of finance, and that's really where this relates is, for example, Jacqueline's comment about 37% of their investors being diverse. So that's really important. We also know that, all sins can be excused in investing by just having enough time to invest. So do we get young people into the game early enough? If they join when they're 25 as opposed to 40, is that great? So the data question could answer some of those sort of policy questions.
Yeah, and I just like to point out, like in theory, if you're the buy and hold investor, as the majority of Robinhood investors are, if you're a buy and hold ETF, yeah, time is on your side. If you're investing in individual stocks, or if you're investing regularly, or if you're investing in options, the evidence over many years, over decades, is that ultimately that is not a winner's game, that you will lose money in that. So I think we need to distinguish between access to investing, healthy investing practices, and access to practices that in fact aren't healthy for the investor, don't promote long-term success. But, on the data question, I would say, I don't think there is this kind of data available about how the investors at any particular firm do. There was, at the hearing that Jacqueline was mentioning, with Gary Gensler and the other regulators, there was, in fact, a draft bill that was considered that would require disclosure of the percentage of investors who made or lost money in options trading, which is kind of an interesting concept. In other words, to get the sort of salient information in people's minds, it's one thing to say this is risky. It's another thing to say, 75% of people who made this trade lost money on this trade, or 2% of people who made this trade lost money on this trade, or 25% made money. I mean, so that investors can sort of understand in real world terms what we're talking about when we say that's a risky strategy.
But then you get into an investment advice, which I believe that would fall under. And for instance, Robinhood can't do that. Brokerages can't do that.
It's information, not advice. If you just say this was the experience and it's based on real world data. And in fact, brokers absolutely can give recommendations. Robinhood chooses, a self-help model, but there's nothing that presents, like if I went to a traditional broker dealer, there would be nothing they don't provide that information, don't get me wrong, but there would be nothing that would prevent them from doing so.
I guess I had a question, and maybe Colin might be the first person to jump in on this, but when we think about what is wrong, the legacy investing model, who it's not working for, what doesn't work, is it actually the case that fintech is fixing those things? Or is it sort of saying, hey, we've got a solution, we need to find a problem, but for now we have a solution which involves less friction? Where are we in terms of actually seeing fintech investing through apps solve real problems?
I think we'll we're so early in the fintech days to actually be able to, show long-term, does this actually create the kind of equality and kind of wealth distribution that we really want to see? But I think, the theory and the hypothesis is that, being in the game in the first place is the only way that you're going to compete. Right. And so being a part of that and getting access to that. And part of that is, very much just knowing about it. And, Robinhood, Square have done incredible jobs kind of marketing their products to, a generation that, like Jacqueline was saying, compared to the same age group many years ago, have a significantly lower amount of wealth. And so, they're bringing people into this world. And for me, that is kind of the first step, right? I think it's on us to actually, make sure that they're benefiting from that through education, through transparency, through providing the tools so that they, can make the trades that they want to make when they want to make them. I think we're going to see a lot happen over the next decade. And I certainly hope it's going in the right direction. And I actually fundamentally believe it is going in the right direction.
So if you think about fintech writ large, I think it's unquestionably the case that technology has solved a lot of problems in the financial services industry. I've been in this area for decades. And when I started, investing really was genuinely limited to the wealthy and upper middle class. The costs were prohibitive. And technology has unquestionably broken down those barriers. They have given access not just to self-help platforms, but also they have made advice more affordable. So I think that's, clearly beneficial. Believe me, there are plenty of problems with the traditional model beyond the fact that it has traditionally limited itself to marketing toward wealthier Americans. That's changed in recent years. There's been, sort of an expansion, but they think they're really, sort of expanding access when they move down into the upper middle class at some of these places. We've lowered our investing minimum to 100,000 instead of 250,000. It's not exactly. So there is clearly, and if you bring the Robo Advisors into the mix as well, consider them as part of this sort of fintech revolution in investing. I think there's unquestionably this benefit of expanding access. And then the question is, if your whole thing is that you're giving people access, I think it carries a special responsibility to make sure you do that in a way that protects their interests. Because if we give them access to something that ends up being harmful for them, even if the harm is ultimately self-inflicted, you can chase them away from the markets and they can stay gone for a very long time. So I think there's just a special responsibility that comes with that.
And the only thing I'll add there, I think, to close out on this topic is, this breaches into a bigger discussion about the lack of trust that inherently exists between certain communities and the financial services industry. And that is almost overlooked and understated in many cases. And that's why I think what we're seeing with the diverse growth of the number of diverse investors with Robinhood's platform per the surveys that we've given to our customers. Again, I can't stress enough that is probably the most important indicator that we're seeing right now that should be continued to look into. The fact that people are coming to the platform because they feel comfortable, because they feel safe, because they don't feel intimidated. And for years, to be honest, too, certain policies and conversations around financial policy still excluded the Black and brown communities from those discussions. So again, a new platform, fintech brings us forward, technology brings us forward, we have to look forward. And if we're really talking about what's best for customers, I know in my case, me personally, I think it's important to look at the facts at hand, right? There's opinion and then there's fact. And we have a serious and growing wealth gap that's going to make it harder. And, for Black and brown families, they're the ones who suffer the most, as I've mentioned before. Customers are buying and holding. I can't stress that enough. People want to learn. People are not as ignorant as some critics may paint them. You're talking about college-educated folks like myself. Even my father uses the app, the platform. He's an aerospace engineer. He loves it, and he's near 60. Robinhood as a platform is an emerging technology that's providing this new opportunity. And making a profit and somebody said the other day, making a profit and making a positive impact on the world aren't mutually exclusive. But when you get to the point that Robinhood is at right now, there is absolutely, Barb, you're right, there is a huge responsibility to do the right thing. And as Colin said to close out, I do believe we are heading in a much better direction that will make investing better and more accessible for millions more people. We're already seeing that today.
Yeah, just quickly on that point of investor knowledge, the average typical experienced investor has a low level of investor knowledge when you test it. They struggle to pass basic financial literacy tests, let alone a test that is relevant to the process of investing. New investors, as measured on this recent research from FINRA and the NORC at the University of Chicago, score even lower. So on a quick 5-question test, they score less than 2 right. 1.5 right on average, whereas the experienced investors get almost half of them right. I mean, so I think we need to be realistic about what the actual knowledge base is of intelligent, college-educated, high-functioning people when it comes to investing. And our policies and our practices need to be based on that reality rather than some idealistic view of their sophistication.
So this is great. I want to make 2 quick comments. One, I've already heard from someone saying 60 is not old. So if you use the math,
I know my dad.
60,
I think my dad's
only 60. Second, I think one of the things that I really think makes this an important conversation is that since the GameStop event, there's plenty of information out there to say that a lot more people are deciding to become investors. That a lot more people are jumping in. So questions about how fintech apps are used increasingly will just become more and more central to all the kinds of questions that are out there about how we represent information to investors. So I just want to let everyone finish with, one final comment, anything you want to add, and then we'll wrap it up.
I think the last thing for me is it's such a fascinating time. I mean, you look at Dogecoin, and that's happening now, and argue whether that's good or bad, right? Like, regardless of where you stand on that and what's going to happen with that, it's bringing people into this world, and for me, I just fundamentally believe that you need to be a part of it, and yes, there are going to be some people who do not come out ahead because of either they didn't know, they thought it was a game, and it actually has real life consequences. But for me, I think this is the first stepping stone into allowing people to really kind of participate, regardless of whether you have necessarily all the tools that someone who is fully educated on something does or not. You need to have the same access, in my opinion.
So I guess I would just say, I think this is an area where we're going to see significant regulatory attention. Our rules for the securities markets were written with a traditional model in mind, where an individual person either made recommendations or gave advice. And we have a whole set of sales practice rules and advice standards that are built for that model. We don't have a regulatory system that's built for the fintech model. In the congressional testimony that was mentioned, Gary Gensler said that the SEC is going to be studying this issue. I think we can expect that there will first be study, that they will act based on information, but that this is an area where we will see more regulatory attention in the years ahead.
And for me, I did want to mention, we have a question from one of the viewers about how Robinhood creates synergy with RIAs and other independent advisors, helping to build wealth. I'm excited to say that we've launched an investing network with our Chief Marketing Officer, Christina Smedley. We actually worked with the CEO and founder of the Stocks and Stilettos Society, which is geared towards Black and African American women investors in America. So we've been reaching out to the communities to make sure that we are having conversations directly with our customers and leveraging the wealth and knowledge that independent advisors have and the reach that they have, to make sure that we can continue to open up this discussion about the importance of investing and understanding the risks that come with it inherently, as well as providing people with the tools and a toolbox and a toolkit that they can use so that they can finally start to feel like they are a part of a market that has only served a small percentage historically. So we're excited to continue to double down on our educational offerings and tools. And yes, I think this year will be great in terms of what comes out of any other activity out of Washington, D.C. And I know that Robinhood is already, looking forward to playing a part in coming to the table with what we see in the industry, what our customers are saying, and making sure that we get to a place that benefits everybody.
Fantastic. So I want to thank our panelists, Colin, Barb, Jacqueline. Really appreciate you having the time to do this and explaining kind of all the things that are going on here. So I hope our coalition, our members, were able to drive some value out of this. It was certainly a topic on everyone's minds, and I think, again, it will only be so increasingly. So please leave feedback, anyone who watched it, and if you have any questions, you can contact me. I can relay them on to our panelists. Again, so thanks for watching.
Thank you. Thank you.
Thank you.
Bye.